Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello, all my Feds, and welcome to this episode of the FedLife podcast. Once again, I am back. I am your friend, Dan Sipe. Additionally, I'm the branch manager here at Sipe and Associates and Serving Those Who Serve. I want to thank you for taking the time to listen. And as I always do, I want to thank you for your service because you don't hear it enough. All the things that you do that people take for granted, not going to happen here. So thank you. And we are back with the Fed's best friend, Ed Zurndorfer, or as we call him, the guru, as part of our ongoing mission to reach, teach, and serve you. Here comes the disclaimer, folks. Have to say it every time. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, not the opinions of Raymond James serving this podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have one, hit us up at Serving Those Who Serve. We will do what we can to help you. As by now, if you're a regular listener, we follow Ed's FedZone articles, which are dynamite. He has them coming every single week and sometimes special ones. And that's just another way that we're able to reach, teach, and serve you. So in this episode, we are covering Ed's article entitled, Recently Passed Stimulus Act Results in a Third Stimulus Payment for Eligible Individuals. Okay, so another check or deposit may have already come or could be coming from the act that was signed in March. So Ed, tell us about the scope of this round because it's a little different from the previous two.
Yes, so the latest Stimulus Act was signed into law in March, early March 2021 by President Biden. And it includes a third stimulus payment for 2021. We had two in 2020. Actually, the second one was paid out mostly in early January 2021, but the law was passed. Those payments were passed basically into law during 2020. But the third one was passed definitely in 2021 in early March and signed into law. And this is a little more generous stimulus payment for eligible individuals. We'll talk about who's eligible. In particular, every individual, if you're talking about a family here, every member of the family is entitled to a $1,400 stimulus payment. That's per family. So if there's 6 family members, let's say the parents and 4 children, that's a total of $8,400.
Wow.
That's a lot of money.
Yep.
That was one of the features, and there are actually other benefits coming out of the family, what I call family benefits coming out of the Stimulus Act, and I will be writing about those in subsequent FedZone columns. In particular, the child care child care tax credit was expanded, and I will be talking about that, and that's going to be a huge benefit to a lot of people. But that'll be in future FedZone columns.
Okay. And so for somebody to qualify for this, what are the requirements?
In order to qualify for the third stimulus tax payment, you had your adjusted gross income had to be below a certain level. If I may, I'll give you those adjusted gross income levels. If, let's say, during 2021, if you're filing as a single person, your or head of household, I should say, single and head of house. I'm sorry, for single filers, your adjusted gross income had to be below $75,000. If you're between $75,000 and $80,000, you'll get some, but not all of the stimulus payment. If you file as married filing jointly, your adjusted gross income had to be below $150,000. If you're between 150 to 160, you'll get some, but not all of the stimulus payment. And finally, if you file as head of household, the adjusted gross income limitation is you have to be below 112,500. And if you're above 120,000, you'll not get anything. You'll get something, but if your AGI is between 112,500 and 120,000, I want to point out those are pretty steep. The range here is very small. So it doesn't leave a lot of room for the first two payments are in terms of AGI. And I want to emphasize that These are for 2000. This is based on 2021 AGI, adjusted gross income. And the reason I'm saying that is because these payments were actually they started paying these, the Treasury, actually IRS started paying out this third stimulus payment starting in early March. So the question comes up, early March. This is March 2021, but you're giving me these AGI limits for 2021. What is the IRS psychic? They know what your AGI is going to be in 2021? No, they're not psychic. If you filed let's say you didn't file your taxes as of early March 2021, IRS is going to base your stimulus payment based on your 2020 AGI, not your 2021 AGI. So this is going to be very interesting because I know you're going to have a question then. If somebody doesn't get let's say the third stimulus payment based on their 2020 AGI, let's say it was too high, can they still get it? But I'll let you answer that question.
Okay, Ed, let's say somebody wasn't able to get it for their 2020 AGI, which was too high, but for some reason their 2021 might not be. Can they still get it?
They can when they file their 2021 taxes next spring, in spring 2022. This is identical to what's happening with the 2020 stimulus payments. When you filed your 2020 federal income taxes, there was a form there, a worksheet called the Recovery Rebate Credit. And that the purpose of that worksheet was for people who, for some reason, did not qualify for the 2020 stimulus payments because when they filed their in 2020, those stimulus payments were based on your 2019 AGI if you had not filed your 2020 taxes. Okay, so therefore, because you hadn't filed, it was based on 2020 AGI, I should say. So now that you're filing your 2020 taxes right now, it turns out that your income was much less than 2019. You'll get the stimulus payment when you file your 2020 taxes. And the same thing's going to happen next spring when you file your 2021 taxes. If your AGI was less than the limits I mentioned, then you'll qualify for the 2021, the third stimulus payment, next spring. It'll be part of your refund.
Gotcha. Okay. Number one, that seems fair. But you go a step further in the sense that you have some ideas in your article for feds relative to their 2021 income that might help them qualify. Why don't you talk about some of those?
Okay. Based on what I said, you want to keep your 2020 for a fact right now. You're not going to qualify for the 2021 stimulus payment, not the full amount, at least. Maybe do some things during this year to decrease the amount of your income in 2021. When I say your income, we're talking about what is contributing to your adjusted gross income, basically salary, capital gains, interest, dividends, IRA conversions, things like that. Are there any things you can do to decrease your AGI during 2021 so as to be able to qualify for the full third stimulus payment when you file your 2021 taxes?
Mm-hmm.
And among the things you could be doing is contributing to the traditional TSP.
Yep.
Let's recall that the traditional TSP, the contributions are coming from your gross salary. They're being deducted from your gross salary. If your gross salary is $80,000 and you are contributing $10,000 to the traditional TSP, your taxable wages are reduced to $70,000. That's $10,000 less of AGI. Let's suppose in 2020, your AGI you file as married filing jointly, and your AGI, let's say, was $155,000, $155,000. Under the limits I mentioned a few moments ago, if you're between $150,000 to $160,000, you'll get some, but not all, of the third stimulus payment. But assuming nothing else changed with your income in 2021, if you're putting another $10,000 into the traditional TSP, that's going to reduce your AGI down to $145,000, which means you'll qualify for the full $1,400 stimulus payment, the full amount. And let's keep in mind, it's not just for one person, it's for the whole family. Like I say, if you are married, filing jointly, and you got 4 children, that's $8,400.
Sure.
By putting $10,000 into the TSP, reducing your AGI below $150,000, that's going to put another $8,400 of money in your pocket come next spring.
That's worth it.
So it's well worth it. It's a good return on your money, putting in $10,000 to the TSP and getting $8,400 back. I think that's a good return on your money.
Sure, and take it a step further, since folks can put in more than $10,000. And this is something that we talk about a lot, Ed, you and I, the fact that 20% of feds do not even contribute up to the 5% match. So they're leaving money on the table. So whenever, I know you recall the days 1,000 years ago when we used to do presentations in person, we'd talk to a big auditorium and say, okay, I need you to look one way and look at the other. And out of a group of 5 of you, one of you is not getting all the money. Okay,
it's amazing. It's amazing the amount of money left on the table, and you have to think down the line. The money you're putting into the TSP, it's growing at least tax deferred, and in the case of the Roth TSP, tax free because the money's going to come out tax free. Over the years, that money is growing.
Yep.
So this is just one example where you can reduce your AGI. You're helping yourself because you're putting your money into the TSP. You're helping yourself for the future, and you're being rewarded now in the form of additional refund. I call it a refund that's not even taxable money.
Yeah, and as you point out, up to $8,400 coming back, that's a very big bite out of 19.5.
Oh,
my
goodness.
Sign me up for that deal. Uncle Sam, I'm putting my hand up right now. I hope you see me. I will take that deal every year. No problem. And any way you want me to do it, I'll take that.
On the other hand, Dan, there's some things people should not be doing that could increase their AGI. If you're thinking about converting a traditional IRA to a Roth IRA, because you like the idea of Roth IRAs and you can't contribute to a Roth IRA because your income is too high, I'd be very cautious on converting a traditional IRA to a Roth IRA and having to pay the tax due on the conversion, because that, in fact, the money the amount of your IRA, traditional IRA that you're converting is considered to be income. It's going to add to your AGI. Another thing that federal employees should be careful about, particularly retirees who are taking money out of their TSP. One of your options for taking the money out of the TSP is that you could transfer your traditional TSP to a Roth IRA. That is also a taxable event and is going to add to your income. So be very careful. I have many discussions with clients about, they say to me, I'd like to get back with you after tax season, so I want to talk about how I can get more money into my Roth account. And one of the items we're going to talk about is, what is your AGI? You don't want to convert too much of your traditional account to the Roth account if it means you're going to pay much more in taxes this year. There's a strategy here. There's a lot of planning that goes into this, Dan. And it's very important that someone does not just say, I'm going to do this, I'm going to do that. You have to really work with somebody who's very knowledgeable, in this case with taxes, also your financial advisor who's hopefully familiar with the TSP as well as other retirement accounts to know what is going to be the best thing for you.
Gotcha. Now, that makes sense. Any other thoughts that you have on the stimulus payment and decisions people should be making this year?
Also, in terms of reducing your AGI, I just want to say something else. There's some other ways that you can reduce your AGI. Those federal employees who have health savings accounts, HSAs, in which they can put money into their HSA. There's a maximum contribution to HSA this year. I believe it's $3,500 if you are self only, and if you have self and family, you file a self and family, and you have an HSA for your family's health insurance, you can put a maximum $7,000 in there. Federal employees have access to HSAs, and they can, on their own, contribute to the HSA. The money going in that you contribute is an adjustment to one's income. So if your adjusted gross income, again, I want to use the same example. Your adjusted gross income, you're married, filing, jointly, is $155,000.
Yep.
You put, if you want to put maybe $3,000 into your HSA, $3,000, you have up to $7,000. And by the way, if you're over 55, you can throw in another $1,000. People over 55 can put an additional $1,000 into their HSA. That's going to reduce your AGI down to $152,000. So this is good, particularly for people who are retired from federal service who cannot contribute to the TSP. You cannot contribute to the TSP because you're retired from federal service, but you can contribute to your HSA up until the time that you enroll in Medicare. That's another subject, but let's just say you can put money into the HSA after you retire, and any contributions that you make will reduce your income. If your income is, like I said, my example, $155,000, putting $3,000 into that HSA reduces your AGI down to $152,000. So we're getting closer to the point that we're able to get a full $1,400 stimulus payment. If you're not retired, let's say you have access and you don't have an HSA, you have access to health care flexible spending accounts, to health care FSAs, as well as the dependent care FSA. Also, the money that's being contributed to those accounts are coming off your gross salary. Gross. So that's going to reduce your gross salary. That, in turn, will reduce your AGI. It's something to think about. And just as a preview of what I'll be writing about, the expanded flexible spending accounts, particularly for dependent care. Right now, the limit is $5,000 per family. It's going to go up to $10,500. However, the amount that you can put into your dependent care FSA, and it's not just for kids. If you have, let's say you have a parent who lives with you and you claim that parent as a dependent, and your parent has to go to an adult daycare center, or somebody has to come to the house to take care of your parent while you're working, that's eligible for. You can pay those expenses from your dependent care FSA. The amount that you can put into your HSA, dependent care FSA, also will depend on your AGI. Again, I'll be writing that up probably in the next few months, what the expanded HSA, what the flexible spending account amounts will be and their limits. But we should plan to make sure that if you want to use the full amount of you want to make the full maximum contribution, that your AGI has to be below a certain limit.
Gotcha. Those are great tips, Ed. And we've got a little bit of time left. I thought we'd go off script here a little bit and talk about people's favorite topic, which is when they can retire. And you write fairly often about the best dates to retire for specific years and that sort of thing. And I was wondering if we could just talk a little bit about what goes into picking those best dates from your point of view. So if you were sitting down with somebody saying, okay, if you got locked out of reading my columns, remember these things about picking your best date to retire.
First requirement, Dan, they're picking the right day to retire. Are you really ready to retire? Are you prepared to retire? That's the first requirement before you pick a specific date. You got to make sure that you're really ready to retire and know what to expect. All right. That being said, and we teach this during our CSRS and Fers.
Oh, we have webinars, Ed? We have webinars?
Yes, we do. With my co-host, Jennifer Meyer. Now we have Matt Kramer on there. It's just so it's a wonderful. So we have a wonderful team here, and we give webinars at maybe 6 to 8 a month, every month, Dan.
Yes, we do.
And we have such a good time, and we really enjoy this, and we like it so much, we keep doing it every month. Every month, there's 6 to 8 months. I didn't know if you're aware of this, Dan.
I am now.
Well, one of the things we talk about during our CSRS and Fers webinars, and we always have at least one of each. We have Fers. We always have Fers every month. The next FERS webinar is going to be held, by the way, on May 4th. The next CSRS webinar actually is coming up a week from Monday on April 26th. If I can push it with your permission, just advertise a little bit here. One of the things I point out during the webinar is the fact that if you are a CSRS employee and you're thinking about the best time of the month to retire, a CSRS or serves office employee should always retire either on the last day of the month or the first 3 days of the next month. And the reason I say that is because if you retire, for example, on December 31st, let's say this year, 2021, you're a CSRS or serves office employee, your retirement becomes effective on January 1st, 2022, and you get your first CSRS annuity check dated February 1st. And the same thing would be true if you retire on January 1st, January 2nd, or January 3rd, 2022. But if you retired any time between the 4th of January and the 31st of January, your retirement would not become effective until February 1st, and you wouldn't get your first annuity check until March 1st. Ouch, that's nearly 2 months after you retired. Please understand.
That's not good.
Please understand. When you retire, you're off the payroll. You're off the payroll. No more checks coming in. But I assure you, even though you're off the payroll, what will be coming in are your bills.
Oh, yes.
When you retire, your bills do not retire.
Nope.
That's a very important lesson here. In order to get that first retirement check as soon as possible, a CSRS or service office employee should try to make every effort to retire either on the last day of a month or the first 2 days of the next month. Now we get to the FERS employees, and this is the easier one, because no matter what day of the month a FERS employee retires, his or her retirement becomes effective the first day of the next month, and they get their first FERS annuity check, the very first one, the first day of the month thereafter. So if somebody retired, let's say today is April 15th, FERS employee retires. Their retirement would not become effective until May 1st, 2021, and they wouldn't get their first FERS annuity check until June 1st, 2021. That's nearly 6 weeks away. That's a long time.
I'm sensing the last day of the month is a good idea.
The best day of the month for a FERS employee to retire is always the last day of the month.
Makes sense.
Some other things you got to consider about this. When you're first retired from federal service, you will not repeat, even though you may retire on the days I recommended. The first 3, 4, 5 annuity checks you're going to be getting from OPM are not full checks. They're what they call interim checks. It's going to take OPM's Retirement Office Processing Center, located in Boyers, Pennsylvania, anywhere from 3 to 6 months to adjudicate your retirement package, and they'll be sending you what's called interim checks that are guesstimates of what you're really entitled to. They're guesstimates, and the guesstimate is anywhere from maybe 30% in some cases, might be as much as 80 to 90%. You're not going to be getting a full check. That's the bottom line. But once OPM adjudicates your retirement package, then they'll start sending you what you're entitled to, your full annuity check, and whatever they didn't send you with those interim checks, they will make it up and send what they owe you with that first check. So you're not going to lose any money. But here's the point I got to make. Yeah, those first 3 to 6 months, maybe you're not going to get full annuity checks, but you got bills to pay. You're not getting a paycheck. You're not getting a full retirement check. How are you going to pay your bills? And what many retiring federal employees do to help pay their bills while they're waiting for that first full annuity check is to depend on a nice payment for their unused annual leave, your unused annual leave. Any unused annual leave you have at the time of your retirement will be paid to you in a lump sum payment. Mm-hmm. And you will receive that lump sum payment within 2 to 4 weeks after you retire. It's direct deposited into the same bank account that you get your paycheck, you getting your paychecks.
Gotcha.
OPM is not paying that lump sum annual payment. It is your payroll processing center. So if it's your intention to get paid for as much unused annual leave as possible when you retire, you should try to make every effort to retire at the end of the leave year. I did not say the calendar year, I said the end of the leave year. Usually they're pretty close. The leave year starts with the first Sunday in January, and it ends on the first Saturday of the following January. For example, this year, the 2021 leave year started on January 4th, 2021, and it's going to end on the end of pay period 26 is Saturday, January the 1st, 2022. So if you retire, let's say this year on January 1st, 2022, and let's say you carried over 240 hours of unused annual leave, which for most employees, that's the most you can carry over from one leave year to the next of unused annual leave. You could, in fact, get paid for as much as 448 hours of unused annual leave. In some cases, this could be like $30,000 to $40,000, which, by the way, is taxable. But that will carry you over till you get your first annuity check. So here's my point. If it is your intention to get paid for as much unused annual leave as possible when you retire, the best time of the year, Dan, to retire is at the end of pay period 26, which is late December or early January. This year, as I said, the end of pay period, end of leave year 2021 is Saturday, January 1st, 2022. Now, does that mean that everybody should retire on January 1st, 2022? Suppose you are a Fers employee. What happens, Dan, if you retire on January 1st, 2022?
You're going to wait a while before you get your first check.
Like March 1st, 2022? Yeah.
Yep.
But guess what? You don't have to. You don't have to retire on January 1st, 2022. Why? Because January 1st is a federal holiday, which means you can retire on December 31st, 2021.
Nice.
And this way you'll get your first annuity check on February 1st. You do not have to come to work in order to retire on that day. You could be home. You're going to be home on December 31st, 2021, preparing for your New Year's party, right, Dan?
Oh, yes, absolutely, because I already got my first shot. I'll definitely have my second shot by then.
Okay. And therefore, you retire on December 31st, 2021. Then you'll get your first annuity check come February 1st, 2022. You could get paid for a maximum 448 hours of unused annual leave, assuming you carried over 240 from the previous year and you didn't use any annual leave this year. You're just accruing 8 hours every 2 weeks. Now, this is what I point out during my webinars. Also, I write this up. I have a column that I write up every year entitled "The Best Days to Retire." Some people do not want to retire at the end of the year. They like to retire in the middle of the year. So here's what I recommend.
Okay.
These are my rules for the best time of the month to retire. Ideally, you will retire as close to the end of the month as possible, at the end of a pay period. And the reason I say that, Dan, is in order to accrue the 6 or 8 hours of annual leave for the pay period that you're going to retire in, you have to retire no earlier than the second Saturday of that pay period. Pay periods end on the second Saturday of a pay period, the second Saturday.
Gotcha.
If you retire any time before that second Saturday, you can retire, but you're not going to accrue any annual leave for that last pay period. So always make an attempt to retire on the second Saturday of a pay period. If you are a Fers employee, make every effort, again, to retire at the end on that second Saturday, but within the last 3 days of the month. This way you'll get your first annuity check sooner than later.
Nice.
If you are a CSRS or CSRS offset employee, again, retire on the second Saturday, but you can go into the first 3 days of the next month in order to get your first annuity check as soon as possible. Putting this all together, I look at the OPM calendar for federal employees, and I do this every year, and I've done it for 2021, I've done it for 2022, and I'm actually going all the way out to 2024, in which I see where the end of pay periods are throughout the year and where they fall, where the end of pay periods fall within the last 3 days of the month, or the first 2 days of the next month, and I came up with a recommended list of retirement dates for both CSRS and Fers employees. And I have the list for 2021 and 2022 in front of me.
Let's tell them.
Obviously, we're a quarter into the year. We've passed some dates here. I'm not going to mention dates that are already passed this year. Let's go forward here. If you're a CSRS employee, if you are a CSRS employee or a CSRS offset employee, the best days to retire this year for the rest of this year are July 3rd. It's a Saturday. It's the end of a pay period. July 31st, the end of a pay period, end of the month. August 28th, a Saturday, the end of a pay period. And then in 2022, a good day to retire will be January the 2nd, 2022. And the reason I said January 2nd, 2022, and not January 1st, is because January 1st is a federal holiday, If somebody retires on January 1st, they won't get the holiday pay for that pay period. They won't get the holiday pay if they retire. So you want to be on board. Okay, so January 2nd. For 2000 and 2022, the best days to retire for CSRS and CSRS offset employee are January 29th, February 26th, July 2nd, July 30th, December 3rd, and December 31st. Fers employees, your best days to retire are, for 2021, July 31st, a Saturday, August 28th, a Saturday. Again, these days are all within the last 3 days of the month. December 31st. For 2022, January 29th, February 26th, July 30th, and December 31st. If I can say one thing about December 31st, 2022, Dan, I want to say one thing, why that is such a special day. Please mark your calendar. December 31st, 2022 is a Saturday. It is the official end of pay period 26 for leave year 2022. If someone retires from federal service, it makes no difference CSRS or Fers, on December 31st, 2022, that person will receive his or her first annuity check, whether it's CSRS or Fers, dated February 1st, 2023, and would get paid for a maximum 448 hours of unused annual leave. Why is that? Because assuming they carried over 240 hours for the leave year 2021, and you're accruing 8 hours of annual leave every 2 weeks, and not using any annual leave during 2022, and then they retire at the end of pay period 26, December 31st, they could end up accruing 208 hours of annual leave added to the 240 carryover makes 448 hours of unused annual leave. I have to point out that this particular occasion in which the end of the leave year and the end of the calendar year, it only happens every 11 years. The last time it happened was December 31st, 2011. It's going to happen December 31st, 2022. I already looked at the calendar. It's going to happen again on December 31st, 2033. And it'll happen again on December 31st, 2044. So anybody who's eligible to retire in 2022 may seriously want to consider December 31st, 2022 as a day to retire. It's a great day. It only happens every 11 years, as I say.
Man, that's better than a 17-year cicada. And bam, that is the stuff that you don't get anywhere else, folks. I'm telling you, this is the only guy that is doing this. Ed, again, don't know how you do it. Glad you do it here. Glad you do it with us, and glad you do it for the feds. So, folks, that is a wrap. As Ed mentioned, be sure to check out his live webinars with Jen Meyer, with Matt Kramer. Yes, the team grows. There are more and more people working to reach, teach, and serve you, so do not miss out on that. Be sure to read Ed every week in the Fed Zone. Hit us up at swserve.com. Just click your way through or go to fed-zone.com. Check us out on Twitter and LinkedIn. And again, hit those webinars. swserve.com. You'll see the big red button. Attend one, attend all, attend them multiple times. I'm pretty sure we have somebody who's attended 30 already, Ed.
Wow.
Which is pretty impressive since we didn't even start them until the middle of last year because of COVID. We will keep them going, and glad to have some super fans out there. We are averaging about 100,000 people coming through the site in a year now, and that is so gratifying. Want to see it up there. Our goal is to have all 2.2 million of you knowing about this and knowing this is a place where you can come to get the information that you will not get anywhere else. So, for Ed, the crew and serving the crew of serving the serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations. Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.